What's up, everybody? Michael Silva here. You're watching the Stock Market Brief Show. This is what bear markets do. That's what we're going to talk about on today's episode. I'm going to prepare you for some things that maybe some people might be overlooking because they get a little bit wrapped up in the FOMO, the fear of missing out on a monster move. But this is what bear markets do. They have your insane face ripping rallies, and you can see here that was one today. Dow Jones was up 2.5%, S&P was almost up 3%, the Nasdaq Composite was up 3%. These are by no means small moves, and keep in mind Nasdaq volatility still remains above 30. The VIX and Orvol or Russell volatility still remains to mid 20s to high 20s as it stands right now. If you take a look at the 11 sectors that make up the S&P 500, all the way down to financials, each one was up 3%. So yeah, if you got caught in this mess, face ripper. That's indeed what took place. Now, this is very normal in bear markets. What do I mean? Well, look at all these red lines on the screen. I'm just pointing out on the Nasdaq Composite that pretty much since the start of the bear market going into this year, every red highlighted candle, you'll notice that every face rip and rally has got pinned to the closing high. So it closed at the high of day and or right by it. You can see just all of these moves, all of them highlighted in red. They're basically closing at the high of day. And guess what? What took place there from an emotional standpoint? Every single face ripping rally, everybody was trying to call the bottom, which we all know is not a great thing to do. Now, overall, we talking about this one right here. We had our follow-through day here. Then we followed through distributions. We're like 20 days in from previous this bottom over here. And we're seeing some move, right? We have a low, higher low. So, yeah, we have some positive stuff taking place. But understand also that the market is highly correlated right now. So, yes, when you have some big names go up, guess what? The market's kind of going up, which is not good, especially from a downside perspective or a risk perspective, because if one big name gets hit, it could take the entire market with it. That's the correlation chart that I'm kind of paying attention to here. If we keep walking on through this, I want to kind of call out a couple of things. We're going to look at some BP charts. What you'll notice here is they are moving into that overbought condition, but they're not quite there yet, letting us know that there could be more steam in this squeeze to the upside. If we go look at the BP NDX, same thing, still got room to potentially go up higher. The financial sector BP chart still has room to go higher. However, when you take a look at the 11 sectors, the big three, it's going to be XLK, all right, XLF, financials, and then also XLY, which is consumer discretionary. Okay, so when these three are up, 3% a piece, 3% a piece, the market's going to have an amazing day. That's for certain. But here's where it gets a little bit interesting. I track expected moves. Take a look at financials. Financials is tagging its 50-day moving average, whatever, and it's also at just about at the weekly expected move that it's been priced in. So we're at the near edge of the higher end. If you take a look at, say, technology BP chart, the BP chart here for technology still has some room to run, but it is getting into overbought territory. And if you take a look at the weekly expected move for technology, we close at the high. Look at the upside potential here, right? This is what the options market priced in, right? 68% of the time, it'll close within this range. The market has been, the options market has been a little inefficient as of recently, but it's still something to be mindful of, that you have so much potential for downside risk versus the upside reward on these couple of day move to the upside. So almost tagging the upper edge there. If you keep going on consumer discretionary, take a look here. This will probably be overextended coming out with Netflix earnings. It looks like it's up after hours, which we'll go into here momentarily. But you can see that it has a little bit more room to go there too. And if we look at XLY, the other horseman over here, this is also nearing the upper edge of the weekly expected move as well. And it's only Tuesday, and the market is still pricing in a lot of volatility. So we cannot be shocked if we see continued volatility. So why is the market roaring up right now? Well, my best guess here is if you just look at the dollar. We've been talking about the correlation charts. The dollar's been coming off these last 3 days, and what do you know? The market is rallying. So if the dollar finds its foot and starts ripping back up, buckle up, because it could get a little wild here in the equity markets. If we take a look at this specific indicator, I like to use this to potentially front run volatility. And it's where we basically put a 10-period rate of change on this relative strength line between SPIP over GOVT. When it gets into around 1.3, sometimes it's been a good leading indicator that volatility may be around the corner. It's not there yet. It's been floating around just under that 1% marker. So I'm keeping an eye on it, but you can see here all the red lines. That's when it took place, and you can see shortly thereafter, volatility came and spiked up. Now, this doesn't mean it's a holy grail indicator by any chance, but it is something that I've been tracking. And if it gets to the low end, which is more minus 2%, you can see the green. This is where volatility is backed off, and then it was most recently right here. You can see volatility has been backing off. Interesting stuff. So I'll continue to monitor that, see if we get some sort of a pop to the upside here on that rate of change. If we take a look at Netflix after hours, you can see here it hit a high of $225. We talked about this yesterday about a plus or minus $32 expected move. Well, that was tagged on the upside there for Netflix, so it should open around 215, 216, at least where it stands right now, but it definitely tagged up into this upper weekly expected move. So we'll see how much more juice that there's left in the tank come tomorrow. And then we have Tesla reporting earnings. The current expected move brings us outside of the weekly expected move, and it's still, about a 50-ish dollar range here as far as what the market's pricing in for the earnings expected move. And you can see here, Tesla's still in bearish context and still coiling up right here. It's going to be an interesting one. Last time we reported earnings, we gapped up and everyone's like, haha, yahoo! And then it just kind of just fell over. So just be careful. Obviously, be careful, or be very tactical if you're trying to do earnings plays. Yeah, I'm not going to dive too much into that one. If you take a look at the SPY, we started cracking outside of this, tightening pattern over here. So is there more upside? Yeah, possibility, right? We got above the RSI on the 50 marker. We had a little bit of volume come in, but understand that we're also nearing a previous area right here of resistance, and that's also in confluence with the upper weekly edge or upper weekly expected move. So if we start breaking through that, where's another level to watch? 400, obviously, right? That's a gap fill right there, and it's a nice psychological level to keep continuing to monitor. Now, if we take a look at the 15-minute time frame, people are getting really bullish here. Yeah, yesterday we pulled into the 5-day moving average. RSI was getting a little oversold, and we bounced, right? And it was a very aggressive bounce. This is, if you just look to the left of the chart, okay, we haven't gone anywhere since the 10th of June, all right? We've just been going like this, down, up, down, up, down, up. That's all we've been doing, and it's been aggressive moves to the upside. I remember it here, and I remember there. Oh, the bottom's in, up, the bottom's in, and then it falls out, then it falls out, then it falls out. Up, bottom's in. Doesn't mean it's necessarily going to be another fallout, but just be aware that that is taking place. Now we're getting that upper weekly expected move, okay? We have a little bit of a negative divergence there. You can see momentum also slowing down there. So that is there good trade ideas right here? Well, from a short perspective, if you're playing it tactically, yes. Other than that, we are kind of in this little squeeze. And if we get outside of these weekly expected moves, as we previously discussed, remember, a bigger gamma squeeze can come from it. So be aware of that as well. If we take a look at the Qs, coming up to that upper weekly expected move there too as well. Did close the gap right here, just about on that. So we'll see if there's some more upside. This has been taking place on decelerating volume. RSI is back above 50. MACD is still below 0, but it's moving up, and it's still within this compression pattern. So nothing, honestly, to get overly too excited about, and you can see that more clearly, once again, here on the 15-minute time frame. You can see strong moves to the upside or followed through with some big moves to the downside, all right? So don't get FOMO. Just be aware what's taking place. If you just look at the price action, it is getting choppy. It's, tearing people up back and forth. So you got to play tactically from ranges, buy, or sell at the high end, buy at the low end, if that's how you want to play, or short at the high end, cover at the low end. As it stands right now, all the index products are above their 5-day moving average, and it's starting to incline. So there's a shorter term bullish bias here, but always look for pullbacks back to it because it is a frequently tagged EMA. As you can see, the last time we tagged, boom, it acted as a level of support. If you take a look at the IWM, did break out here, and it's outside of its weekly expected move with some strong volume. So if the SPY tags the weekly expected move, and then also the Qs come to tag the upper expected move as well, this can probably go outside a little bit further. Me personally, I think this is where you would want to start looking for short positions on the IWM. That's just kind of, my thought process here and the way that I go about this, just so people are aware, because I am building out some short positions as it stands right now. I am at this moment using options in order to do it, and I'm not going heavy. Typically when I do options, it's 1 to 2% max of my entire portfolio, because if I'm wrong, right, I lose 1% of my portfolio. So it's kind of like whatever at that point, right? So yeah, when I'm doing options, and even when I short, if I'm shorting the equity itself, a full position for me, you can get up 10%, even plus, but on my short positions, they are divide that by 2, right? It would be a 5% position, because I know that shorting is obviously, you have to be much more aware of what's taking place and you can get squeezed. If you take a look at the 15-minute time frame, continuing on here, 15-minute time frame, you can see here we're above that expected move. RSI, negative divergence, bearish crossover, strong move to the upside, hasn't got digested yet. You can see this kind of distribution of volume right here, right? We talked about that when we talked about that here. We talked about that here, and we said, hey, if it gets outside of it, it can act like a magnet, and we pull back in multiple times to it. So is it possible that we pull right back to it? Yeah, obviously. We'll see here if the squeeze is over or if it's not. One other thing that I want to show you before we end it today is this. This is new. I'm not going to probably be sharing it here, but I've been sharing it with my Patreon group. I spent this entire weekend plus looking through these various scripts because I want data to be able to compile from a statistical manner, quantitative looking at these daily zones. And what I found was pretty interesting, and now I'm starting to track it, put notes out there, and kind of people can follow along if they want to or if not. But what I want to point out here is I'm showing you the symbols here. On the Patreon group, I show this, but I also show like the one S&P 100, all the stocks within the S&P 100. And these aren't buy or sell recommendations. These are dynamic. They're constantly moving. But this is for tomorrow. So if you want to screenshot this and maybe like, hey, like let's see if this is how accurate this is. But as it's telling me right now, so if you look at the SPX, okay, the low of the zone is at 3776. The high of the zone is at 3944. The closing price is at 3936.69. So what does that say? Well, according to this, the upside potential here is 0.19%. Now remember, these are dynamic. It can still go up, but then also dynamic to the downside too. So what this is telling me here is the S&P 500, there's more risk to the downside than there is reward to the upside by a pretty large margin right now. Okay, so this is also a reason to be kind of cautious. But it's not just the S&P 500. If you look at the IWM, upside is minus 22, which basically, what does that mean? It means that it's actually trading outside of its daily zone currently right now. So that could potentially update coming into tomorrow. It's at 178.29 is where the high is. 178.69 is where it's trading. But then the downside is almost 6%. So what does this also say? It means don't be surprised if all of a sudden in the next day or week or whatever, the S&P 500 just takes a hit down 4% to the downside. And you could see coming down the list, really the only thing that has like a positive upside right now versus the downside, according to these spiders, is XLU. It has approximately around a 3% upside with a 1.14% downside. Now, this is not to say it's going to go to these levels, so please be mindful of that. I don't really feel like digging too much into the what this actually is, but just understand they are dynamic, they're constantly changing, but it gives you a good idea as far as timing entries a little bit better. But that's all I got for you on today's episode, everybody. Hope today's episode helped out. Be careful out there, right? Don't be getting FOMO. Wait for the price to come to you for your setups, and just be tactical right now in this environment. If the bottom's in, we will have plenty of opportunities to get in and play it from the long side. I guarantee it. But as it stands right now, the bears are licking at their chops right now during these squeezes. That's all I got for you, everybody. See you later.